All right, let's jump right in. We're going to talk about a pretty fascinating idea today. What if you could get your S&P 500 stocks to pay you like a job, a regular monthly paycheck? Well, there's an ETF out there that says it can do pretty much exactly that.
I mean, it's a powerful question, isn't it? We all want cash flow from our investments, but man, we hate the idea of having to sell our shares to get it, right? Especially when the market's taking a nosedive. This is the exact problem, the exact pain point that this whole strategy is built to solve.
And honestly, this quote from financial analyst Tony Hicks it absolutely nails it. Own stocks, rent out some of your upside, get paid every month. That is the perfect one-sentence summary for the Goldman Sachs S&P 500 Premium Income ETF, ticker GPIX. So what in the world does renting your upside actually mean? Let's break that down.
Okay, first things first, what is this ETF actually trying to do? What's the main goal here?
So the best way to think about it is like a hybrid. It's trying to give you two things at once, a steady stream of cash and a smoother ride. And it wants to do that while keeping you invested in the long-term growth of the biggest U.S. companies. The idea is you get that income now without having to give up all the potential growth later.
All right, so that's the what. Now for the how. How does this thing actually generate that money every single month? Where is this cash coming from?
Okay, so at its core, GPIX is really powered by two different engines, and they're working together. Engine number one is your growth engine. That's just owning the S&P 500 stocks. Simple enough. But engine number two, that's the income engine. And this is where it gets interesting. It's a strategy that sells something called call options to collect immediate cash. And that renting analogy we talked about earlier, this is exactly what it is. Think about it. You own the asset, the stocks, and you basically agree to sell them at a higher price in the future, but only if the buyer wants to. Just for giving them that option, they pay you a cash fee. They call it a premium, right now, today. You are literally renting out a piece of your potential future gains for cold hard cash in your pocket today. This whole process has a name. It's called a buy-write strategy. And it sounds fancy, but it's actually pretty simple. Step one, the fund buys the stocks. Step two, it writes, which is just another word for sells, these call options against those stocks. And bam, step three, it collects the cash premium. That cash plus any regular stock dividends is what becomes your monthly payout. But here's a really, really crucial detail. GPX isn't just on autopilot. It's actively managed. That means there are actual people behind the wheel who can adjust the strategy. They get to decide just how much of that upside they want to rent out. So if they think the market is about to really take off, they can pull back a little bit to try and capture more of that growth for you. It's flexible. Now, as we all know in the world of investing, there is no such thing as a free lunch. This income, it has to come from somewhere. And it comes with a really big trade-off. We have to talk about this, so let's get right into it.
So here's what it boils down to. On one hand, you get that monthly income we've been talking about, and potentially a much smoother ride with less volatility. So what do you give up? Well, you give up a piece of the really big wins. In a roaring bull market, when everything is just shooting for the moon, this fund is almost guaranteed to lag behind a simple S&P 500 index fund. You're basically trading potential home runs for a steady stream of singles and doubles.
And look, the income can be really attractive. Recently, the trailing yield has been hanging out in the high single digits, around 8%. But, and I can't stress this enough, that number is just telling you what has happened. It is not a promise of what will happen. It's going to fluctuate with market conditions, with volatility, with the fund's price. This is absolutely not a fixed interest rate like you get from a savings account. So let's be crystal clear on the risks, okay? This is not a bond. It is a stock fund, which means it can and will lose value at times. Your big upside gains are capped. That monthly payout amount, it's going to change. And at the end of the day, a lot of its performance depends on the managers making the right calls. Okay, so with all that in mind, how does GPX actually stack up against the competition? What about the other popular ETFs that are trying to do a similar thing? Let's take a look at the neighborhood it lives in. First thing to notice is its price tag. This is a big part of GPIX's pitch. The fund charges just 0.29% a year. And in a field like this, where high fees can really eat away at your income stream, being one of the lower cost options, that's a pretty major competitive advantage. And this table really tells the story. You've got JPI over here, which is a massive competitor. It uses a really complex mix of low volatility stocks and these fancy derivatives called equity-linked notes. Then you've got XYLD, which is basically a robot. It just follows a super strict rules-based formula no matter what. GPIX is trying to carve out a spot right in the middle. It says, hey, let's just stick with the pure S&P 500, but give our managers the flexibility to adapt. And it does all of that while charging less than both of those big rivals. So you see, its niche, its sweet spot is really for the investor who's thinking, you know what, I want the S&P 500 to be my foundation, but I'd love to bolt on a flexible income engine without getting super complicated or paying a really high fee. That's the target. Which of course brings us to the final and frankly, the most important question of all. Does this specific tool, does it actually fit your personal financial goals? Does it fit your temperament as an investor? Look, to know if this is for you, you have to know when it's built to shine and when it's built to lag. It's going to shine when the market is just choppy or going sideways or even down a little. That's its sweet spot because it can just sit there and collect that option rent month after month. But in a massive melt-up bull market, it's pretty much designed to lag behind because remember, it already sold away some of those huge potential gains. So who is the ideal investor for something like this? Let's run through a quick checklist and see if this sounds like you. Number 1, you want that monthly cash flow from your stocks. Number 2, you are perfectly willing to sacrifice some of the big home runs in exchange for more income and a less bumpy ride. 3, you'd rather have a professionally managed, hands-off solution. And 4, you're a fee-conscious investor. If you find yourself nodding along to those points, well, then this strategy might be right in your wheelhouse. Because ultimately, it all comes down to this one very personal question. And there is no right or wrong answer here, but your answer, it determines everything. Is that steady cash flow, that consistency of a monthly paycheck from your stocks, is it worth leaving some potentially huge gains on the table? Is it worth knowing you might not capture every last bit of a massive rally? Answering that question for yourself, that is the absolute key to deciding if a strategy like GPX is right for you.